There we go. Okay. So whenever you go out to apply for these consumer loans, guys, you have to think about your credit score. Is there any way we can get an extra, hold on a second, an extension on the homework? Are they due tonight? Oh yeah, I'll move them. Don't worry about that. Because the test is not until next week, so I'll move them. I don't have a problem with that. Okay,
Thank
guys.
you so much.
No problem. So guys, whenever you get ready for these consumer loans, you have to think about your credit score. Your credit score is basically, guys, a report card. This is a grade. It's a report card which tells you or tells whoever the consumer is that's trying to extend credit to you how great you've been taking care of your credit, okay? Now, guys, I saw something recently. I'm not going to mention it because I'm not sure how firm it is. But for now, the credit score, guys, ranges from 300 up to 850. Now, when we talk about the credit score, guys, depending on how high your credit score is, that determines what happens with whether or not you get finance or not, guys. So the credit score, guys, ranges from 300 to 850. The higher the credit score, the better it is to be approved for a loan, and the lower the interest rate. So let me write this one down for you guys. So higher score, if you have a high score, higher the score, lower interest. And then vice versa. The lower the score, the higher the interest, okay? So individuals with a 730 plus credit, 720, 730 plus credit, these are the people with impeccable credit. They've got great credit. And don't forget about the ones that are in the 800s. If you're looking in the 800s, guys, these are the people who can walk out with a car loan at 0% interest rate. I'm serious, guys, serious, okay? Now, you've got the low end on the 600 or below. These are the individuals that are questionable. They've got questionable credit. These are the ones where they may not get credit, and if they do get credit, they get the highest interest rate on credit. And so the credit card interest rate, the car loans might be as high as 29.99%, guys. So the bottom line is this: you must take care of your credit score, guys. How do you take care of your credit score? An easy way to take care of your credit score is to make sure, guys, you go to annual credit report.com and get a free report from the 3 credit bureaus every year. You are entitled to a free credit report from Experian, Equifax, and TransUnion. Now, what are you looking for? You want to look for any derogatory information, the information that's dragging your credit down, guys. So if you find any derogatory information, or perhaps information has been reported erroneously, make sure you dispute it immediately on the website. Give them about 4 to 6 weeks and they will respond to you. If it's not your account, if you didn't incur the charges, you didn't open up the account, that's supposed to remove it from your credit report. And most people can manage to clean up their credit history on their own without paying someone, all right? So guys, I needed to mention that about credit because all of these sections right here, these 3 sections, they're all associated with credit. So guys, cars, when you get ready to purchase a car or a vehicle, you have to decide, do I want to buy new or do I want to buy used? Okay. Now, for the new vehicles, guys, listen, when you purchase a new vehicle, you get a whole lot of perks with it. It's a brand new car. The interest rate is lower. You're the first person to drive it, obviously. On the maintenance, you get more warranties. You get the maintenance packages. There's so much that comes with a new car. But the most important part about a new car, guys, is the interest rate you get. the interest rate on a new car is better than the interest rate on a used vehicle. Now, for these cars, you can finance them up to 72 months. Personally, when I finance a vehicle, I like to extend the loan out so I get very small payments. And then what I do is I send extra money on top of my regular monthly payment. So guys, for me, when I get a loan, I always end up paying it early, okay, to avoid paying all that interest. So essentially, whenever you have a loan, whether it's a credit card, a mortgage, a car loan, always send a little extra, guys. Don't just send the bare minimum, especially with the credit cards. Do not send the minimum, always send extra, okay? Now, the used cars, they can be financed as well, but in order for them to be financed, it has to be a certain year, a minimum number of years, okay? Well, there's a maximum number of years for it to be financed. Additionally, guys, the amount of money you want to finance has to be around $5,000, at least $5,000 for you to be able to finance it, okay? So you have to decide, do I want to buy new? Do I want to buy used? The other thing you have to decide is, do I want to own or do I want to lease, okay? Now, the leasing, guys, is what I'm talking about. First, when you lease a vehicle, it's never yours. You lease a vehicle for like 2-3 years, and then after the lease is up, you have to return the vehicle. You can do one of two things: go into a new lease, or perhaps you can negotiate the price of the car and purchase the car and start making payments towards the purchase of the car. Now, the leasing limits the number of miles, guys. It limits the number of miles. I saw a commercial the other day for Porsche of Palm Beach. Listen, guys, you know how many miles they give you on this car, this very expensive car? 5,000 miles for the year. Who drives a car for just 5,000 miles for the year? Shazam, okay? But guys, the lease, the drawback to a lease is that they limit the number of miles you drive per year. And if you return the car with an excess number of miles over what you agreed to, you're gonna have to pay a fee penalty, okay? Additionally, guys, for the lease, here's a great thing about having a lease. The monthly payments are lower. It's easier to get into a lease than it is to get into owning a vehicle. The monthly payments are lower, okay? Now, what are some of the benefits of owning a car? Okay, what do you guys think? What are some of the benefits of owning a car? Anybody?
It's an investment.
Say it again.
An investment.
Yeah. Okay. Now, personally, I wouldn't consider a car an investment unless, of course, I'm going to use it for Uber or Lyft or something like that. Because an investment for me is something that's putting money in my pocket. And it's hard to rationalize to me that a car is going to put money in my pocket. I like to call a car, guys, a necessity. Yeah, a necessity. Those of you who do Lyft and Uber, yes, investment. But if you're just buying a car for the sake of buying a car, guys, I don't know about that, okay? The investment part of it, okay? So some of the benefits of owning a car, obviously, guys, the car is yours. You can do whatever you want with the car. Once you're done making the payments, the car is yours. Nobody can come and take it away from you, okay? And so for this, a lot of people, they make this decision based on finances. If you've got a lot of money, you can afford to lease a car, guys, every 2 to 3 years, go for it, whatever, okay? So guys, now, once you get ready to go shop for that vehicle, best place to stop at is a credit union and get pre-qualified. The credit unions, they're very easy for you to have a relationship with them. Stop at a credit union, and now you can even go online like Navy Federal, guys, and apply for a car loan right there, Navy Federal, okay? And the credit unions, they have the best rates around. So once you have your pre-qual letter, you can go ahead and go shopping for the vehicle. Remember to negotiate the prices, guys. Negotiate maintenance packages. Negotiate the dealer fee. Remember, they will try to take advantage of you. Additionally, ladies, I'm sorry, ladies, I'm not being sexist or anything like that. My guys probably can say this to you. Ladies, please, I think there's still some individuals out there who believe that women cannot carry out a business transaction. So ladies, when you go car shopping, try to bring a man with you, okay? So people don't try and take advantage of you, okay? So negotiate the prices. Now, once you decide to purchase the vehicle, guys, okay, you've negotiated the terms. By the way, another thing I like to look at when I'm purchasing a vehicle, guys, when they give me the monthly payment, I could care less about the monthly payment. Tell me the interest. Give me the interest. I don't care about the monthly payment. Tell me the interest rate. Ask them for the interest rate, guys. So make sure you ask for that interest rate, okay? Now, once you get ready to go to the table and finalize this deal, the dealerships sometimes have a tendency to try and get you to finance with them. If they give you a better rate than your credit union rate, go ahead and go with it, guys. The point is, if you have that pre-qualification letter from that credit union, you can use it as a bargaining tool to help you get a better rate on your car loan, guys. And don't be afraid to go ahead and negotiate, okay? Now, guys, additionally, let's move on. Check these websites to see what you're paying for these vehicles, if it's the right price you're paying for these vehicles. Kelley Blue Book, Edmunds.com, True Car. What's another one? Make sure you get your Carfax, okay? Especially if it's an older vehicle, get your Carfax, guys, all right? Now, remember, guys, if you decide to go and purchase a car, lease a car, you need to have a down payment. You need a down payment, guys. You need a modest down payment. Personally, I think 20% is a really good start for a down payment. So if you're purchasing a car for $30,000, you need to have a solid $6,000 to put down. If you're doing $50,000, you need to have a solid $10,000 to put down, guys. So have a solid down payment. Now, additionally, guys, remember, you're going to have to pay for taxes, tags, okay? Taxes, tags, registration, same thing. The taxes, I forgot to mention this. Taxes, you can write them off on your tax return, depending on whether or not you itemize. So the taxes on any vehicle, I mentioned this when we were talking about taxes, you can write it off on your tax return, guys. So keep that in mind, okay? Then you've got your dealer fees. The dealer fees they can get you can negotiate that too. What other fees do we have? I think that's about it. If you want additional maintenance, usually new cars, they come with maintenance, but if it's a used car, you want additional maintenance, you might have to pay for that as well. Okay, guys. So now, the other thing is this, when you purchase these vehicles, the premium vehicles, guys, premium vehicles, what premium vehicle am I talking about? The premium vehicles are the luxury vehicles. Premium vehicle equals premium tire, premium gas, premium maintenance, premium everything, guys. So is it really worth it to get a premium vehicle as in a luxury vehicle? I mean, the purpose of a vehicle is to get you from point A to B. That's it. Do you really need to have a premium vehicle? The other one we have to consider, the gas guzzlers, the SUVs, the big trucks, guys. Do you really need one of those that does what, 15 miles to the gallon? Those things are gas guzzlers. Do you just want to go ahead and go with a little Ford Escort? Do they still make those? Shazam. Okay. Do they still make Ford Escorts?
No.
I haven't seen one. Well, thanks for saying that, man. Okay. So now, guys, don't forget about the insurance. If you're financing, you have to carry full coverage on that vehicle. All right, I'm going to do a quick problem with you guys regarding the car because I want to make sure I have an example on the video. But what's going to happen is that when we go through the work, we'll do some additional examples, guys. So here's an example of a problem. Suppose you go ahead and go to Kagen Honda or something like that. Kagen Honda, and you want to purchase an what's a good car? An Accord, okay? You're purchasing an Accord. The Accord is $25,000, guys, okay? And so you want to put $5,000 down. You want to put $5,000 down, and you want to finance $20,000. Now, Of course, there's taxes and tags, dealership fees and stuff like that to consider, but we're not going to include that on here, okay? So the car, let's pretend, is $25,000 out the door. You put $5,000 down. So the amount you're going to finance is going to be $20,000. That's how much you're going to finance. That's how much you're going to borrow from the bank, guys. Now, it just so happened that your credit is decent. You have a 700 credit, and they give you a nice interest rate of about 4% interest, okay? By the way, guys, that's not too bad. 4% interest is not bad. You're borrowing $20,000, and they're going to give you the loan for a total of 6 years at the 4% interest. So now, guys, we're going to calculate the monthly payments. Now, for the monthly payment, guys, remember this is the formula we use for mortgages, credit cards, and the car loans. So here's the monthly payment formula, guys, okay? P times R over N divided by, in the denominator, guys, be careful because when you go on My Math Lab, they did not put the brackets in the denominator. So make sure you include the brackets in the denominator. Additionally, guys, the exponent here is a negative because you're paying down the item. So over time, the amount of money you owe is effectively going down. That's why the exponent is a negative. Now, one more thing. What do you notice? The variables are still the same thing that we're dealing with before. The only difference is PMT. PMT meaning payment, guys, okay? So it's still the same formula, all right? Now, I would write this formula down, and next to the formula, I would put mortgage, credit card, and cars, okay? I would put that next to the formula. Now, I am going to clear out some of this, guys, so we can go ahead and do the problem because I don't want to erase the entire thing. So I'm clearing it out. Oops, I'm gonna leave this part in there, okay? So the payment for this one is going to equal to 20,000 times, by the way, let me write this down on the side. Guys, when you're using the payment formula, N is always equal to 12, always, because you make 12 equal monthly payments per year, always 12, okay? So 20,000 times R, the interest rate, which is 0.04 over 12, divided by, in bracket, 1 minus 1 plus 0.04 divided by 12, and we're going to raise it to the negative 12 times 6. As in, we're making 12 equal monthly payments every year for 6 years. Now, this is where hopefully you have an awesome calculator. You can go ahead and put this on your calculator. Everybody should practice putting it on the calculator right now. Even if you're using the calculator on your cell phone, guys, practice plugging it into the calculator, because when you're doing the test, you got to know what you're doing. Now, pretty much, guys, we are going to type in this problem exactly like you see it on the calculator, okay? So you're going to do 20,000, open parentheses, 0.04 divided by 12, close the parentheses. Then you're going to do divided by, open parentheses, divided by, open parentheses, guys. Don't use brackets, use parentheses in place of the brackets. So we're going to do 1 minus, open parentheses in the denominator, okay, we're in the denominator, 1 plus 0.04 divided by 12, close the parentheses, and then, guys, hit your power key. And remember, I like doing my work ahead of time. So for the power here, I'm going to use negative 72. Okay, for my power, negative 72. And what is this going to produce? It's going to produce the monthly payment, guys. So the monthly payment for this car turns out to be $312.90. Did you guys get this? Did you guys get it?
Can you write down how to enter into the calculator one more time? Because I keep getting an error and I don't know what I'm doing wrong.
Okay, sure. I'm gonna have to erase all of this though. You know what, let me erase the top. It may be your negative too. Sometimes students put in the wrong negative symbol. The negative is the one in parentheses, so be careful. So on your calculator, you do 20,000, open parentheses, 0.04 divided by 12, close parentheses, divided by, open parentheses, 1 minus, open parentheses, 1 plus, 0.04 divided by 12, close the parentheses, and then you're going to hit your power key. Are you okay with your power key? You know where your power key is at?
Yeah, I figured that out last time.
Okay. And then raise it to the negative 72 power. And then make sure you're using the negative that's in parentheses, okay? Did you get it?
Hang on 1 second, I'm still entering.
All right, that's fine. One disadvantage to leasing a car is that you are not responsible for any damage to the car. That's false, guys. You are responsible for damages to the car if you lease. One disadvantage to leasing a car is that most lease agreements have mileage limits. That's true. Let me see here. What's another one? Okay, I'm not seeing a good one. Okay. Now, once you're done with the lease, guys, you got to return it to the dealership. You can't keep the car. Either negotiate a new lease or negotiate the price of the car down so you can purchase it. I've paid off my car loan, so I'm not required to have liability coverage. That's false. You have to have insurance on your vehicle.
Gap insurance is very important too.
Oh,
Professor.
yeah. Life insurance?
No, the gap insurance. So in case you like total your car before you're done paying for it. So it.
Yes. Good point. I'm glad you brought that up. Gap insurance. The problem with my car lease is that when it ends, I have to be concerned about selling the car. That's totally false. You just return it to the dealership. Did you get the answer, lady?
Yes, ma'am, I did. Thank you so very much.
All right, no problem. Okay, so guys, those are the cars. Okay, I just needed to do one example and get it out of the way. So now let's go ahead and go into the mortgages. Oh, my favorite topic. I love talking about mortgages. Okay, guys. For the mortgages, this is a long-term installment loan. So the car was kind of like short-term because it's only up to 7 months, but the mortgage, guys, listen to this. For the mortgages, you can do a 30, 40, or even 50-year mortgage. Now, I like to give mortgage a definition, guys. The word mort in mortgage in French means to die. Muerte is the Spanish version of it, to die. And engage, as in engage, guys, okay? So when we talk about a mortgage, we were essentially talking about an engagement until death. Now, why do I present it this way to you? Because most individuals really don't end up paying off their mortgages until either they pass away or they move out of the house and sell it, and obviously they keep their profit, whatever, and then pay off the mortgage holder. Yeah. So guys, imagine this, you're 25 and you take out a 50-year mortgage, shazam. You're gonna be 75 before you can pay off that mortgage. Yeah, okay? So mortgage, an engagement until death. However, home ownership is encouraged. If you're going to be in an area for at least, guys, at least 3 years or more, home ownership is encouraged. Because for most individuals, renting an apartment is super expensive, whereas sometimes they can get into a mortgage and get a cheaper monthly payment. But of course, home ownership has its downsides too, okay? So then the question some of you have to ask yourself, should I rent or should I own? Now, since this is the section on mortgages, we're talking about home ownership. When you decide to purchase a home, guys, you have to decide, do I want a single family? Do I want a townhouse? Do I want a condo? Do I want a villa? You got to decide what kind of property you want. How many bedrooms do you want? How many bathrooms do you want? Okay. And then, of course, you have to get, again, pre-qual. And for you to get pre-qualified for your loan, they have to look at your credit. How good is your credit? Right now, we have historically low interest rate on these mortgages, but many people are not qualifying for them because their credit score is not high enough. Guys, over the summer, a lot happened that people weren't aware of, okay? The banks started being really hard on lending money. They weren't just lending money to anybody. Your credit had to be awesome for you to get a loan. So guys, be careful with that credit score, very important, okay? So once you get your pre-qualified, you go ahead and look for the house this time. You go ahead and find your house, guys, and you decide on the house. Now you're ready to go ahead and start the financing process, okay? You start the mortgage process. Now, for the mortgage process, guys, first and foremost, you need a solid down payment. Now, to avoid what we call PMI insurance, private mortgage insurance, you want to put a solid 20% down, just like before. I bought a house this summer, and hold on a second, let me read what Denise is saying. Oh, that's awesome, Denise. I thought you would find that. And oh, yes, thanks for sharing, Denise. That's awesome. That's a great interest rate. Shazam. And a lot of people were refinancing this summer too, guys. Yeah, okay. So anyways, guys, PMI, avoid PMI by putting 20% down. If you put less than 20% down, yes, you're gonna have to pay PMI insurance. By the way, guys, most people can, first-time homeowners, can afford a beautiful mortgage with an FHA mortgage. That's the government-backed mortgages. Additionally, guys, the cities, they have first-time home buyer programs. I know in St. Lucie County, yes, they have first-time, let me write this down for you guys, first-time home buyer programs. And for these programs, they will help you with down payment, as well as closing costs, guys, closing costs. And I'm sure you guys live here, okay? You see all the building that's going on around here, okay? If you finance through the builder will pay your closing costs if you're in the market for a home. Later, can you talk about refinancing a vehicle? Yes, Tavion. Why didn't you ask me that earlier? I forgot about that. Shazam, absolutely. Okay, so guys, closing costs, down payment, first time home buyer program through your city. Check out your city. Check out your county. They have these programs. The only way you're going to find out is call the city, call the county and ask them, do you have this program for first time home buyers? A lot of people use these programs, guys, to get their first home, okay? And then the builders, if you decide to build your home, you finance through them, they will help you with closing costs, guys. Homeownership is wonderful, guys. By the way, homeownership is the first reason why people can go ahead and itemize their deduction, because you can claim all the interest on your monthly payments, guys. You can claim it on your tax return, okay? So guys, let's go ahead and carry on. So now you've decided to put down your down payment, and now you're going to go through the mortgage process. So for the mortgage process, guys, okay, you have to decide, do I want a fixed rate mortgage, fixed rate, or do I want an ARM? ARM, okay, fixed rate mortgage, guys. This is where your monthly payments remain the same for the life of the loan. Your monthly payments remain the same for the life of the loan. Most individuals have a 30-year fixed mortgage. Now, that fixed mortgage includes, your monthly payment includes interest, principal, the price of the home, taxes, as well as insurance. That's what your monthly payment includes. The insurance they collected, the taxes they collected, they put them into these accounts called escrow accounts, guys. So when the bill comes in every single year, they take the money out of the escrow accounts and pay off the insurance, pay off the taxes. Now, guys, the ARM mortgages, is what got this area into a lot of trouble back in 2008, where people were walking away from their homes. These are called adjustable rate mortgages. Now, guys, listen. This is what caused the problem. Adjustable. These mortgages were adjusting. They never adjusted down. They always adjusted up. So you would purchase a home where you're making a monthly payment of $1,500, and next thing you know, you have to pay $2,500. Who's got the money for that? So people just decided to walk away. You know, I love talking about ARM mortgages because for me, this was a warning sign, guys. If you're going into a mortgage call on ARM, this means that you're going to have to give up an arm for this mortgage and even maybe a leg for this mortgage. Shazam. Okay? I mean, that was a nice warning. Ironic, right? Okay, but anyways, guys, let's keep going. So most people are going into fixed rate mortgages these days. Back then, you could pay your insurance and your taxes out of pocket, but nowadays they want you paying all of that as part of the mortgage, guys. Now, you're going to have to pay a whole bunch of closing costs. Not only do you put a down payment, you got to do the closing costs too. The closing costs, guys, includes a whole lot. They include taxes, doc stamp. By the way, the closing costs, they're included on this piece of paper, long sheet of paper called the HUD settlement statement. HUD settlement, I'm going to try to write it here, but I know I'm not going to get all of it in here, guys. HUD settlement statement, or well, anyways, it's a long sheet of paper, guys. It details everything you're paying for as part of the closing costs. So you got taxes, you got doc stamps, you've got lien searches on the property, you've got property appraisals in there. There's so many other things. There's a myriad of things that are included on here, okay, guys, on the closing costs. So that's what you have to take to the table with you as well. Now, additionally, guys, some people, they like to purchase points to lower the interest rate on the mortgage. Yes, they like to purchase the points to lower the interest rate on the mortgages. We are going to talk about the points. However, guys, listen, the problems are not going to be including the actual points in the calculation with the interest rate. You just have to calculate how much you pay for X number of points. By the way, 1 point is equal to 1% of the mortgage. 1 point is equal to 1% of the mortgage, guys. Now, just so I could go ahead and show you guys an example for the video, I am going to go ahead and just grab a problem from the textbook, guys, and we're gonna go ahead and chat about it, okay? So guys, here we go. Let's say you decide to purchase a home that's $200,000, okay, guys? And this home, because the interest rates are so low, is gonna be financed at 4% interest, 4%, okay? And you're going to finance this home for 30 years, everybody, 30 years, okay? And then you're going to put 20% down, Shazam, because you have money like that, okay? By the way, you can do 3%, 5%, 10%. The higher the down payment, the better it is. 20% helps avoid PMI insurance. 20% down, guys. So you have to calculate the down payment first. So let's calculate the down payment. To calculate the down payment, we're going to take the price of the home and multiply it by the 20%. 20% as a decimal is 0.2 or 0.20, which gives you $40,000, guys. That's the down payment. Next, I forgot to mention, we are buying 3 points. We're going to buy 3 points to reduce the interest rate on this mortgage, okay? Next, we're going to calculate the mortgage. How much money are we going to borrow for this mortgage? So your the home price was $200,000. You're putting down $40,000. So essentially, you're going to finance $160,000, guys. $160,000. All right. Now, I'm gonna have to erase some of this, guys, because I need space to write, okay? So next, guys, we figured out the mortgage amount at 160,000. We're going to calculate how much we're going to pay for the points. We are going to purchase 3 points. Each point is equivalent to 1% of the mortgage. So for the points, guys, we're going to take the mortgage amount, which is 160,000. Since we're buying 3 points, we're going to multiply it by 3%. 3% as a decimal is 0.03, 0.03. So grab your calculator and multiply this. It's going to turn out to be 4,800. For our problems, guys, I just want us to calculate how much it's going to cost for the points. However, we're not going to actually reduce the interest rate. By the way, for those of you who are curious, okay, when you say buying the point, how much does it reduce the mortgage by? Okay, I'm going to tell you how much it reduces the mortgage by. I want to be accurate. I'm looking for it in here, but I'm not seeing it. But guys, I'm going to tell you, when you buy 1 point, it will reduce the mortgage by 0.125%, 0.125%. So you buy 3 points, it's going to reduce the mortgage by 0.3. Ooh, I'm trying to write 0.3, 0.375%. Okay, my board is not writing. Okay, guys, 3 points would reduce the interest rate by 0.375%. Okay, so that's for real life. We're not actually doing it in this problem. All right, guys, here comes the next part. Now, you've taken care of the points. So now, guys, we're going to calculate the monthly payment, which reminds me, I forgot to do something about the cars, guys. I forgot to tell you how much interest, okay, you would have had to pay over the life of that car. Remind me and I'll go back to it in a little bit. Okay, guys, remember, we're using the same payment formula. The payment formula is P times R over N divided by 1 minus 1 plus R over N to the negative NT power, because we're paying down this mortgage. Pay it down, pay it down. Always send extra money, guys. Always send extra money. Okay, so guys, what's the mortgage amount? 160,000. So let's do this, people. So the payment will equal to, get your calculators ready, 160,000 multiplied by 0.04 over 12. Remember, this formula always uses 12 for N, divided by 1 minus 1 plus 0.04 over 12, raised to the negative 12 times 30. Why 30? Because we're taking out this mortgage for 30 years. All right, guys. So let's get those calculators and practice on those calculators. I'm telling you guys, don't wait until the test to practice with your calculator. Try it now on your calculator to see if it works. If it doesn't work, you know, like Jules did earlier, ask me a question. Can you tell me how to type that into my calculator? Okay. 0.04 divided by 12. Close the parentheses in the numerator. Divided by, in the denominator, use parentheses instead of bracket. Parentheses, 1 minus, parentheses, 1 plus 0.04 divided by 12. And then we're going to close that parentheses, hit that power button, guys. Notice I did not put that multiplication there, but let me go ahead and drop it right there. I'm using negative 360, guys, because remember, I like doing the work ahead of time instead of having the calculator do the work for me. So bam, 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 bam. Okay, you guys tell me what you got. What'd you guys get? Because I got my answer. Anybody? Okay, 760. Oh, Denise, you got it. Awesome. All right, 763.86, Denise. That's what I'm getting. You're getting 0.90. I'm getting 0.86. Okay, so that's the monthly payment, guys. Any questions? Unlike the car question, I just rounded. Okay, when you round, Denise, you got to round to the nearest cents, and nearest cents would be 2 numbers after the decimal, unless, of course, the problem allows you to round to 90. Okay, so don't take 86 to 90. All right, you'll be short 4 cents, and those 4 cents make a difference, guys. So the monthly payment, guys, your monthly payment is going to be $763.86. So over the life of this loan, we're going to pay $763, guys. I mean, 86 cents, $763.86. 12 times per year for 30 years, guys. So this is how much we're going to pay over the life of this loan. 763.86 times 12 times 30. And then we end up with, ooh, shazam, $274,989.60, everybody. Yeah. So how much interest did you end up paying over the 30 years? So we're going to take the total amounts after 30 years and subtract what we borrowed, which was $160,000. And so guys, here's the interest you're paying over 30 years. This hurts me every time I do these problems, guys, because I'm telling you, oh, Shazam.
So we bought like 2 houses for the price of one.
Oh my God. Okay. Look at that. I mean, some of us don't even have $114,000 sitting in a bank account after working for 30 years. Shazam. Okay. Now, having said that, guys, a while ago, people used to use their home as an investment. Nowadays, I don't call a home an investment because I'm just putting money into the home. Where's the investment? Well, the investment is supposed to come later with appreciation, as in the value of your home is appreciation. But lately, guys, we haven't been the benefits of a lot of appreciation from these homes. As in, it hasn't been building that much equity. Maybe today, yeah, recently, you might have a little bit of equity. But if you think back during the early 2000s, guys, people were walking away with a significant amount of equity in their homes, okay? So let me just say this, guys. If you sell your home at a profit, you can claim the first $250,000 tax-free as a single person. So you can earn up to $250,000 tax-free from the sale of your home. You don't have to pay any taxes on that, 0 taxes. And if you're married, up to $500,000 you can make on the profit of your home. Yep, tax-free, shazam. That's why people used to consider their home as an investment. Most people don't anymore. We have these individuals out there who follow this thing called the FIRE movement. Have you guys heard about the FIRE movement? Nobody's heard about the FIRE movement?
No, what is that?
Oh, shazam. Okay, so the FIRE movement, FIRE is an acronym that stands for Financial Independence, Retire Early. Okay, so these individuals don't believe in working until age 65. They believe in becoming financially free, financially independent, so they can retire whenever they want to, okay? So how does somebody know they're financially free and ready to retire? Well, what they do is they set a goal, a financial goal. Once they achieve that goal, they can go ahead and retire. So here's how they come up with the goal, guys. They figure out their annual expenses. I'm misspelling annual. Okay, their annual expenses, and they multiply it by 25. And that's how, okay, that's how much money they have to aim for. And once they reach that number, they can retire. For example, guys, if a person's or a family, let's use a family. A family has annual expenses of $40,000. They multiply this by 25, 4 times 25, guys, okay? That's 1 million, shazam, 1 million. So once this family reaches $1 million in their various investments, CDs, stocks, Roth IRA, 401k, whatever the combination is, they have that $1 million in there, they choose to retire. And then once they retire, how do they live? They withdraw money from the account. They withdraw 4% every year from the account. Now remember, all these accounts, guys, are riding the market. And so through the power of compound interest, it continues to grow, even though you're withdrawing 4%. And so what's 4% of $1 million? Shazam, $40,000. Yeah, that's the FIRE movement. You guys have never heard about that? Shazam. Well, now you have, okay? Now you have. People talk about it all the time. It's all over YouTube, guys. I'm telling you. Okay, now, before I move on from the mortgages, guys, what are some benefits of renting? So the FIRE movement people, many of them don't believe in home ownership. If they buy a home, they're going to buy it in cash or they rent. Many of them don't believe in home ownership. So what are some benefits of renting? Well, sometimes you can get into a rental with no down payment or a smaller down payment, you know, first, last, and security. If there are issues with the property, you don't have to worry about it. You call the supervisor. Hey, my appliance is broken. Come and fix it, okay? You can choose to move whenever you want to. So you have the freedom, guys, to just pick up and go when you're in a rental, okay? Now, of course, the biggest downside is that it's not yours. So if you want to alter the property, you really can't alter the property that much unless you get permission from the owner. You cannot write off your monthly payments, your interest payments, and so forth and so on. But guys, there are some people who prefer to just go into a rent rather than a home because they just don't want to deal with the headaches of home ownership. You know, what I always tell people is this: when you are a homeowner, Home Depot becomes your second home. I'm telling you guys, the trips I've made to Home Depot. Anyways, guys, so that's it for the mortgages. So now I'm going to go into the credit cards. This is the last lesson. Now, guys, the credit cards, oh my God, help us with the credit cards, okay? So, okay, let me start here, guys. I believe firmly everybody needs at least one credit card. Is there somebody in here who chooses not to use credit cards at all? Not to use a credit card, period. I just don't want to use credit cards. Anybody?
I did that for 20 years. For 20 years, I refused to have credit cards. I watched my parents do it, and I just heard that they were so bad not to do it. If you don't have money, don't use it. And then I didn't have any credit until I was almost 35 years old because I didn't.
Wow, wow. But there was other ways to get credit without having a credit card. I'm sorry.
Oh no, I said I wish I got this class before.
Oh, I'm sorry. I know I talk too much and I tell you guys to stop me from talking too much. But guys, seriously, you need this information. Seriously, you need this information.
Absolutely.
Okay? So guys, let me chat with you for a minute about the credit cards because too many people get into too much trouble with these credit cards. Number one, guys, okay? Everybody needs to have at least one credit card. And here's the key to taking care of credit cards, to managing credit cards. Okay, listen to this. First, you need to have a job. Second, you need to decide, if I charge something on that card, I have the money to pay for it. If you don't have the money to pay for it, you don't have the wherewithal to pay for it, don't charge it on the card. For example, if you go shopping, okay, and you need a new dresser for your bedroom and you find the dresser, okay, and you know you're not getting paid, you don't have the money in your account, but 2 weeks from now you're going to get paid and you can have the money to pay off the dresser, put it on the credit card. Absolutely. But if you're just frivolously using the credit card, you know, to go on shopping sprees, to take your friends out to lunch and dinner and stuff like that, that's ridiculous. That's called abuse, okay? Plain and simple as that. So guys, you have to decide the best way to use credit cards, guys. You buy something on it this month, pay it off in full. Oh, let me say that again. Best way to use a credit card. Buy something now, okay? Once the bill comes, okay? Pay it off in full. Do not carry a balance from month to month. If you can do that and you own those credit cards that gives you cash back, air miles, reward points, those credit cards will be paying you instead of you paying them interest. In other words, you will be using the credit card for free. In other words, you will be using the credit card and getting paid to use the credit card. Yeah. And there's a lot of people, guys, using their credit cards to make money. Did you guys know that? Okay. They're using their credit cards to make money. Yes. I'm one of those people where I'm at the point where for credit cards, if I have credit cards, it doesn't have any rewards for me, it doesn't have any perks. I really don't want it, okay? So when you use a credit card, guys, please do not charge more than 30%. 30% max. What in the world am I talking about? If you got $1,000, guys, you got $1,000 limit on this credit card, do not charge more than $300 on the card. If you start charging more than $300, you are overusing the credit card, and that drags down your credit history. It drags down your credit score. It means that you are relying on that credit card. So over usage of your credit card drags down your credit report, okay? Now, guys, do not pay the annual fees. No annual fee. Look for those credit cards that have no annual fee. If it has an annual fee, go ahead and close it, cancel it. You don't need that. Most credit cards do not charge an annual fee. There are some credit cards, which we call the prestige cards, that do charge an annual fee, but you get so many rewards with those annual fees. It's worth it. Let me tell you, one of the credit cards I had allowed me to get global entry when I travel internationally for free. And you know how much global entry is? $100. So is it worth it for me to pay the $200 fee? Yeah. I'm gonna get my perks. And then when I go through the airport, I can go sit in the executive lounges and stuff like that. Yeah, I'll go ahead and do it. But guys, if you're not doing all of that, make sure you get a credit card that has no annual fee. And remember, you charge something on the credit card this month, pay it off in full. Once the statement comes in, pay it off in full. Don't charge more than 30% on the card. Okay, next. Don't apply for every card, guys. When you go to Victoria's Secrets, you go to the mall, you go to Gap, you go to Hollister, Dillard's, they offer a credit card. Macy's loves offering people credit card. Refuse them. Say no, 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 no. I don't want it. You know what this does? Every time they pull your credit report like that, guys, it drags down your credit score every single time. It drags down your credit score. So when they make these offers to you, refuse them. Just say no, no thank you, okay? You don't need too many credit cards. Don't pull your credits too many times. Like when you're shopping for a car, if you're going to do multiple credit checks in order to get the right loan, make sure you do it within 1 month, guys. So people know you're shopping for this car so it doesn't drag down your credit score. Your credit score, it's very easy for it to go down, guys, but so much harder for it to go up. So much harder, okay? So you gotta take care of it. All right, now moving on with the credit cards. Now, guys, late fees, over the limit. Over the limit. If you are 1 day late, they will charge you late fees. If you go over the limit, they will charge you a fee. You know what you need to do? Call these credit cards. When you call a credit card company, there's a lot you can do, guys. You can ask them to waive the fees, the late fees, the over the limit fees, okay? Waive the fees. And by law, they're supposed to waive at least 2 of these fees for you per year. 2 fees per year, people. Did you know that? 2, okay? By the way, that also counts for your debit cards. If you're a person that's been getting in trouble with the bank where you are overdrafting your account, call your bank. Ask them, can you please waive this fee? Every year, guys, they can waive 2 of these fees for you. Late fees, over the limit fees, overdraft fees. But if you don't call, they won't do anything. Oh, let me say that again. If you don't call, they won't do anything. All right. Now, guys, here's another one. Increase your limit. Why do you want to increase your credit limit? Guys, let me tell you, increasing your credit limit makes you look better, okay, to anybody who's trying to extend credit to you, okay? The other one, low interest. You can call your credit card company and ask them and negotiate with them to lower your interest rate. If they don't want to lower it, just tell them you're going to apply for another card. There's plenty of other cards out there that you can apply for, okay? Now, I think I got everything covered with the credit cards, but guys, let me mention some of the advantages of having a credit card. I'm just going to read it from the book. This is why I tell you guys to read these books. Okay. So some of the advantages, it's more convenient to use than checks, guys. You don't have to carry a whole bunch of cash around with you. Now, it provides a source of temporary funds for you, emergency funds. Worst case scenario, guys, okay? Your lights are about to be cut off. You don't have the money to pay for your light bill. Go to the bank and ask for cash advance or pay your light bill with your credit card. You can do that, guys. You can use your credit card as a source of emergency, okay? So if you don't have the money, you can go ahead and go to the credit card, borrow the money, okay? And of course, pay it off next month once you get paid. Now, many provide amenities such as free miles towards air travel. Guys, there's a whole bunch of great benefits to owning a credit card, but you gotta manage the credit card. People get in trouble because they do not manage the credit card. By the way, the first time young people get in trouble with credit cards is when they go off to college. Why? Because of lack of financial education, guys. Once they hit that college campus, they get bombarded by credit cards. And so many of them are tempted, you know, free gifts, free stress balls, free hats and stuff like that, just to get a credit card. Guys, please talk to your kids and tell them, no, don't do it, Sugar Plum. Oh, I'm going to give you guys a great secret in a minute. Hold on, sweetie pies. I'm calling you sweetie pies. I'm sorry. Okay, hold on. I'm going to tell you. You can see I'm getting excited about this topic because I'm very passionate about these things, guys. So, guys, back in 2009, the Frank-Dodd Act was passed because of the severe problems with student credit card debt. And so in 2009, Frank-Dodd Act was passed, stipulating that in order for a young person to get a credit card, they must have a source of income, AKA a job. If they do not have a source of income, then their parents must co-sign on that credit card for them. Yes, okay? That was in 2009. Because guys, the problem was just astronomical. Okay, so people, I want you to listen to this and listen well, please, okay? You know what, let me go ahead. I'm gonna say it to you out of the video. So just in case, I don't know who's listening, so just in case, okay? After I stop the recording, I'll go ahead and say it to you. All right, guys. So pretty much when it comes to your credit cards, guys, and charging you interest, by the way, the interest rates can go up to 29.99%. And you know what, let me say this. Having a credit card, using money on a credit card is much better than the pawn shop, the check cashing store, okay? That's much better, guys, much better, okay? So stay away from these legalized sharks, okay? Stay away from them, okay? It's better to use a credit card. The interest rate on a credit card can go up to 29.99%. So the question is, how do they calculate, okay, your interest rate on these credit cards? There are three ways they calculate it, okay? The balance at the beginning of the payment cycle, or the balance at the end of the billing cycle, or the average daily balance, okay? So those are the three ways they determine how much interest you owe on your credit cards, guys. Okay, Tania says, that was me because I never was taught. Aw, you're so sweet, Tania. Okay, so now you're getting it, Tania. What you need to do is to pass on this information to other people, especially individuals who are younger than you, okay? Guys, so these are the 3 ways the credit cards will calculate your interest from month to month. Okay, so here's the other thing people don't understand. When a credit card says, okay, your interest rate is 18% per year, it doesn't mean that, guys. They're charging you 18% every single month. No, they take the 12, they divide it by, they take the 18 divided by 12. So actually they're charging you 1.2% per month. That's how it works, guys. Yeah, okay. So let me give you a quick example, guys. Let's say you owe $3,000 on a credit card, okay? And you have, okay, they're going to give you up to 3 years to pay it off. And just interest rate on the credit card, because credit card interest rates are high, guys, 18%, okay? I forgot to mention the prestige cards, you know, like the black card, guys, okay? Those are wonderful cards to have because there's so many perks that comes with them. Those are the prestige cards, okay? Revered black card. All right. So guys, you got $3,000 and you got to pay it off in the next 3 months, 18%. By the way, once again, through our conversation, guys, do not take 3 years to pay off that credit card. One of the benefits of having the Frank-Dodd Act is that, was it part of the Frank-Dodd Act? I think so. When you get your statement, guys, it tells you in detail how long and how much it would cost if you were to just pay the minimum. Never, ever send just the minimum. If you cannot afford to pay a credit card in full, don't send the minimum. Make sure you send more than the minimum. If your minimum payment is $50, Shazam. You don't send $50, send $100, send $200. Okay, if you cannot afford to pay it in full, don't send the minimum. All right, guys. So let's look at the payments for this one. Remember, same formula, P times R over N divided by 1 minus 1 plus R over N to the negative NT power because we're paying it down. So guys, for the formula, we're going to do 3,000. That's the principal. That's how much we owe, okay? That's how much we owe. And then we're going to multiply it by 0.18 over 12. This will be divided by 1 minus 1 plus 0.18, oops, over 12 raised to the negative 12 times 3 power. And then guys, we're gonna grab a calculator and throw this on the calculator so we can figure out the monthly payment. Give it a try, guys, give it a try. 0.18 divided by 12. Close the parentheses, and then we're going to divide it by and go in the denominator, open parentheses, 1 minus, open parentheses, 1 plus, 0.18, okay, and then we're going to divide it by 12, close the parentheses, and then I'm going to raise it to the negative 36 power, guys, and hit enter. Okay, what you guys get, because I got my answer. What'd you guys get? You can type it in the chat. All right. Nobody got the answer? Okay, so let me share my answer, guys. It's $108.46. Yeah. Did you guys get that? Oh, very good, Denise. Awesome. All right, guys. So that's the monthly payment for this credit card. But of course, we got to ask the question, how much interest did you end up paying over these 3 years? Okay, so let's look. I'm going to clear all this out, guys. So the total payment was $108.46. Okay. And so you want to take this and multiply it by 12, multiply it by 3. So this will give us the total payments for the 3 years, $108 0.46 times 12 times 3. Oh, Shazam, guys. Shazam. Oh my God, guys. Oh my God. Did you guys see the number? I'm just so shocked right now. I'm flabbergasted, okay? What? I'm checking it to make sure it's right. 3904.56. So guys, how much interest did we end up paying on this $3,000 credit card charge? Shazam. Shazam. Guys, some people don't even make that on their paycheck every 2 weeks. Okay. Now, if this is not the reason why you need to pay your credit card bills in full, then I don't know what is. That's a lot of money. So guys, when it comes to these credit cards, just be careful. Only use the card if you can afford to pay the entire balance in full. All right. By the way, guys, remember your credit report, you can get it on annualcreditreport.com. It's also, your credit score is also known as your FICO score. And that FICO score is basically a grade, just like you get graded in the classroom. All right, I am going to stop the recording right here. I know there were a couple of